Okay, let's do a deep dive into Intel. We're going to look at this stock the Warren Buffett way. It's a business, it's not just a ticker symbol. Let's study the actual business and let's find out its true value, or at least our calculation of the true value. Now, I'm going to sum up the thesis for Intel. They're in an industry that is very important to the modern world. The modern world is becoming increasingly digitalized. More phones are in this world, more computers, homes need technology, supermarkets need technology, whatever you can think of, it's all becoming digitalized. AI is becoming more prominent, even cars need technology to function. But in order to operate, these technologies need chips. They need semiconductors. This is why semiconductors are known as the underlying technology powering the digitalization of our world. And this is where Intel comes into place. Intel produces these semiconductor chips. And that is a very good thing when the product that your company produces is in high demand. It's a thriving industry, not a dying one. But there's always a but, isn't there? Intel, they've had a lot of problems innovating recently. They've missed previous projections that they themselves set. They're spending a lot of money right now, and they've had a tough couple of recent years where competitors have done better than them. So, if we weigh up everything, is Intel stock a good buy? Let's dive deeper. Obviously, I have to start with the business model. A stock owner is a business owner. You're not just a ticker symbol trader trying to read the green and the red signals. This is Intel's business model. So 52% of their revenue comes from the client's computing segments. So this is essentially the processors that go into laptops and desktops and computers. They're considered the brains of these computers. Client computing for Intel generates $45 billion in revenue right now, and it's been growing at a steady rate over the past 5 years. As more and more people use computers, it should remain a solid source of income for the company. However, although the market as a whole is growing, competition is getting stiffer with the likes of Apple coming into play with their new M1 chips, and with AMD and Qualcomm competing as well. So a second biggest portion of their revenue comes from data centers. These are products that Intel develop to power data centers. These data centers come from governments, businesses, cloud computing, and the communication sector, a range of sectors. It's very important in the modern economy as we need places to store massive amounts of data. However, there is still strong competition in this sector from the likes of AMD, from the likes of Nvidia. We can see this with the way they've struggled to grow their revenue and operating income in this area over the past year. Next, we've got the Internet of Things segments, where their processors are specific for the Internet of Things sector. This does include Mobileye as well, which is used for self-driving solutions. All up, it's worth 5% of their revenue. And then you have their non-volatile memory solutions worth 6% of their revenue. And the last somewhat significant section is the programmable solutions group, worth 3% of their revenue. Essentially, okay, I like to think of Intel as a big chip producing company. These chips are used for a range of different types of technology, and they are necessary for technology to function and for them to work. If this business model sounds complicated to you, don't worry, it is a very hard one to get your head around, especially to learn it in depth. But sometimes, if you take the time to actually learn it properly, it can give you a big advantage in the investing game, because you have less competitors who understand the stock, less investors who know the stock truly, who are kind of competing against you. The fact that it is a harder one to learn is actually a good thing. So I'm going to point out some key things that I've found in their financials. First thing to note is that the price has fallen off a cliff. It was once selling for $64 a share. That price is now $27. This is because the stock market as a whole has been struggling, okay? So yes, that does affect Intel as well. The fact that the stock market struggles, it relates to a range of different stocks. But also, Intel's competition has done well relative to them doing not so well business-wise and innovation-wise. That's another reason why the stock is down. But, okay, we look at the PE ratio now. That is nice and low, 8.3. So all of you old school value investors might perk up at that statistic. And, you know, dividend investors, I'm sure you're probably even more keen. That is a very nice dividend that they pay of 5.4%. Now, the reason that that yield is so high is because the price has dropped by so much lately, which obviously means you get more of a dividend for less of a price. If the price was the same as it was before it dropped by half, well, then the dividend would be half the yield as well. Does that make sense? You know, you pay a lower price, so the dividend yield is higher. Also, the dividend payout has been very consistent over the years, with Intel increasing their dividend every year since the late 90s. So those are some good numbers. That is very nice and consistent. Also, if you look at the PB, that is very good. Actually, not very good. That is crazy good. It currently is only 1.09. This means that you pay just an added 9% for all of the net assets of the business. Essentially, if Intel had to shut down their business, worst comes to worst, technically you'd only lose 9% of the price that you paid, because you'd sell everything and get most of your money back. In reality, you'd probably lose a bit more than that 9%, because assets on the books, on the financial statements, are normally overstated by companies. That's just the way it is. Okay, so I've shown you a lot of the good things financial wise, but now we're going to be getting into the nitty gritty, the not so nice things to look at. First is total revenue. Revenue decreased in 2022 and is actually the same amount that it was in 2018. So there's no revenue growth. In fact, a decrease year over year. Now, the reasons why, when I read through their annual report, Intel said that the reasons were inflation, higher interest rates, and slowing consumer demand. That's their reasons. The free cash flow picture has been very up and down. From 2018 to 2019, it went slightly up, then it went up again the next year, and then after 2020, it's just gone down, and in 2022, it is now negative. And a key reason it's negative is because they're chucking a whole bunch of money, a whole bunch of cash into capital expenditure and building out those factories. So that does require a lot of cash. Now also, we need to take a look at debt, because I've got a feeling that that debt is not going to be so good. So total debt right now is $39.5 billion. Their total income is $13.3 billion. So debt is around 3 times the income. This means if Intel wanted to, they could pay off all of their debt with 3 years worth of income. So to me, that is actually not the worst amount of debt. It is actually pretty manageable. Also, when you scour throughout their balance sheet, you can see that they have $22.5 billion of cash on hand. So, okay, that debt is more than manageable. Now let's try form an intrinsic value of Intel stock. Not the easiest stock to do so, because their business model and their earnings have fluctuated a lot and can be quite hard to understand, to get a grasp of what it is and what it may be in the future. Nevertheless, let's go ahead and let's make some assumptions. If you don't agree with my assumptions, make your own. Investing is a one-player game. You're in charge of your own investments, and you're in charge of the own assumptions that you make according to your knowledge of the company. These are my assumptions. Let me know yours in the comment section below. The first ingredient that we need is free cash flow. Free cash flow is how much cash us business owners get to keep at the end of the day. Now, Intel's free cash flow is a bit of a mess because they invested a lot of that cash over these past 2 years. But this is their free cash flow picture over the past 5 years. Now, let's assume that they can get their free cash flow around what it was in 2020, 2019, 2018, a conservative average of $15 billion. Okay, let's plug that into our formula. Now the growth rate that I'm going to use is nothing. Let's assume that they will not be able to grow that figure at all over the next 5 years, okay? Zero growth. Lastly, the PE ratio that we'll be able to sell it for in 5 years' time, let's be conservative and say it's only about 8 times the cash flow, a PE of 8. Discount rate that I'm going to use is 10% return. In general is a fine yearly investing return to get. Now, if this makes sense to you guys, then that's good. If not, maybe go and watch my video on how to calculate the intrinsic value of a stock. That will give you a better understanding of what the heck I'm talking about. Essentially, I'm getting the cash flows that the business will get in the future, and I'm discounting them back to today to get the true value of the stock. If you do want to download this Excel spreadsheet for Intel's intrinsic value, all of the Investing Academy members can download all of my calculations on the value of a range of stocks. Now, okay, as we can see, this gives us an intrinsic value for Intel of $31 a share. So if anything, Intel stock may be slightly underpriced. If they can surpass these assumptions that I've made, well then the stock would be well underpriced. If they fail on the assumptions, then you could say they're overpriced right now. And just remember that when you invest in a stock like Intel with cash flows that are so inconsistent and with its business fluctuating right now, you do have to make assumptions in order to try figure out the actual true value of the stock. I've made certain assumptions with this calculation. Time will only tell if they're going to be 100% accurate. They will not be 100% accurate, I can tell you that, but the goal of investing is to get a rough idea of the true value of the stock and not a precise idea of the value, because you'll probably or almost definitely be precisely wrong. So I've made assumptions, and now I need to keep track of the business results, the guidance, and the performance as time goes on, because then you can measure how accurate your assumptions were. Okay, now let's talk about Intel's management. Management is an important piece of the puzzle when analyzing a stock, because these are the guys running your business. Intel, okay, they have recently appointed a new manager. They needed one because the previous manager did an absolute terrible job. Terrible with innovation, and the company lagged behind its competitors. So a new manager joined them in February 2021. Pat Gelsinger is his name. And his plans are to invest big in capital investments into buildings, into equipment, foundries, these types of things. Build them now so that they will pay off in the future.
I went to the board and said, we're done with buybacks. We're investing in factories. And that's going to be our, the use of our cash as we go forward. They would be what we call mega fab locations, that we'd be building them such that we could put up to 8 fabs in each of those locations. Each fab, $10-ish billion.
He's got this 10-year plan where closer to the end of that 10 years, he wants these investments to pay off and end up taking advantage of the growing semiconductor industry that they're in. The semiconductor industry currently is worth $600 billion. By 2030, it's meant to be worth 1.1 trillion. If he can achieve his goal of being the #1 player in the market, making Intel the #1 player, they will take a good portion of the pie of the market share.
To reestablish Intel as the unquestioned iconic leader in the industry, we're well on track to do exactly that.
So yeah, this guy has been a part of Intel since he was very young. However, he only just became CEO. He said he wants to restore it to its former glory in respect of the former leaders of the once great business. He seems like a good guy. He's got the right vision. He's spending a lot of money, and let's see if that pays off. All that I will say is he does have a hard road ahead of him. Intel have performed so poorly over the past 5 years, and it is very hard to change a big company like Intel when it comes to directions, its values, its work ethic, its staff, its employees, its innovation abilities, its growth, and everything else. The analogy I use is it's easier to move a stone than a mountain. Intel are a mountain of a company, so it's going to take a lot of work for Pat to change things around. So overall, the numbers on the business are not the worst. They don't seem to be in too much debt. They seem to be paying just under their intrinsic value. They're in a growing industry, which is the chip industry. They've got a new manager, which is always hard to tell how successful he may be. There is a lot of potential with this company here, but they do have to change their ways of underperformance, or else it will be the competitors who profit from this growing market that they're in and not Intel.